Bismillahirrahmanirrahim. So we start this session, and Alexander was nice enough to offer his talk on, investment pitch. And so many of these startups, and you guys are on the call. So you are on mute, but however, at the about 40 minutes, Alexander would go through and his explanation into what are the important dynamics to take care of when you are going into an investment cycle, at least even an early stage investment cycle. And then last 15-20 minutes would be open up for question and answer. So hold off to your question. And what I would strongly suggest, if you have any question, put it on chat, and so that those things that get logged in. And Rafiq is my colleague, is from Park Angels. He's here. He's going to then take those questions and pose those questions to Alexander to answer. So please use chat, as you may have some questions, and those questions will be answered more 20 minutes into the to the end of the hour. With that, Alexander, please go ahead and start and give a little background by yourself, and please. And I'm going to allow to share the screen. So if you have any slides or something, you can do that as well.
It's okay. I'd rather keep it, as a face-to-face conversation. So thanks a lot, Mohammed. Guys, by the way, you can put your questions in the chat, or you can raise up your hands, and I'd be happy to take the session more as a dialogue rather than just me droning on for the next hour. So feel free to be interactive. So a bit about myself first. My name is Alexander. I'm a partner at KAAN Ventures. KAAN Ventures is a late-stage investment firm. We are headquartered in Singapore, also have an office in London, and we specialize primarily on investments in deep tech, which includes areas like quantum computing, artificial intelligence, robotics, new materials, smart cities, and many other tech-heavy fields. As we are a late-stage firm, we primarily deal with companies at Series B+, and we invest in checks of 15 to 20 million on average on a first-time basis. So myself as a partner, I am primarily responsible for our investment operations, as well as working with a few of our portfolio companies when it comes to assisting their growth, as well as fundraising and public relations for the fund as well. So prior to launching KAAN Ventures, which was back in 2021, I used to work in different areas of finance. For example, I worked in investment banking, where I mainly dealt with tech M&As. I worked in private equity, which was investments in European tech, manufacturing, industrials, and real estate. And I also ran my own startup, which was not technological, but it dealt with wine imports from exotic destinations like South Africa, Chile, Brazil, Peru, Hong Kong, and Georgia, the country, not the state, into British hotels, restaurants, and bars. And to be honest with you, it was an education by itself, because me and my partner, we had to figure out everything from scratch, from logistics to contracts negotiations to selecting the wines that we wanted to pick for our portfolio. And ultimately, it proved to be a very good experience for me. So myself, in terms of venture capital, I worked not only at the late stage firm where I am now, but prior to that, I also worked at another VC fund headquartered in San Francisco in the US, which was called Roventa Ventures, and it dealt with earlier stages, so seed stage and Series A. So today, I would love to give you my perspective as to how can startups better fundraise from investors, what kind of things to look out for when it comes to building your decks, when it comes to maybe scaling up from local markets towards the international presence, and many other related areas. So myself, I am originally from Russia, so I can understand what kind of background and perspective are you guys coming from in terms of the Pakistani emerging market when it comes to trying to scale your startups in an economy which is still growing rapidly, but it's not, fully developed to the stage where it is in the UK or the US, where it is difficult to find appropriate investors from idea stage all the way to a big company. And when it comes to the negotiation table, right? So today I would also be covering that as well. So look, in terms of the things that I wanted to cover, first of all, I would first like to talk about the pitch decks, right? Well, the pitch decks are very important because ultimately, this is the first thing that an investor sees, even before he is able to meet you face to face. And even if he's not interested, then it is unlikely that the meeting would take place because he would not want to waste your time. He would not waste his own time. And this is why it is important to have a pitch deck which is able to sell your product, sell your team, and sell your vision, first of all. Unfortunately, there is no ideal pitch deck, right? So a good one would aim to cover the majority of the points, to answer the questions that the investor might have on top of his head, so that he is interested in a face-to-face meeting. In terms of the pitch deck, I would advise on average on a length of 12 to 15 slides, and the topics covering areas like, for example, why right now is the best time for the entrepreneur to launch his product into the market, explaining things like, for example, the key market movers, like, for example, government regulation, reduction in the cost of the raw materials which are used for your product, as well as increase in the purchasing power of your loyal customer base and other things. Also, it is very important to cover an area which relates to, yes, right now might be a great time, but also your solution is not the only one in the market. So you would need to explain why exactly are the other solutions inefficient in terms of what the consumers actually want. So they might be great, but they might be too expensive, or they might be, too long to be delivered or to solve the customer's problem. And so you would talk about, what kind of pains and wants does the customer have, and why exactly are they not currently covered by the market. After that, you would do well to go more in detail about your own product, discussing its features, discussing its specific functional. Maybe if you have a demo, you would be able to show it as well. If not, then some screenshots would do. And then you would talk about your business model, right? Why is the business model important for the investors? The business model is important because it ultimately shows how exactly do you plan on making money. So there are many different kinds of models available. For example, one of the most common ones is B2B, right? So you as a business sell your product to other businesses. Another one is a B2C, which involves you selling directly to the consumer. And ultimately, they are vastly different because the B2B model normally takes much longer in terms of the sales cycle, in that because the businesses that you will deal with as consumers, they have more hierarchical decision-making processes, and ultimately for them to make a decision of whether or not to use your product would be more expensive if they decide to switch on to your competitors later on. They would also be much more risk averse and careful when it comes to doing due diligence on you. But in comparison to the B2C model, the B2B consumers are normally much more able to pay larger checks. And also, if you focus on a rapidly growing business, then it is likely that you would be able to upsell them some additional products or services down the road as they grow. So it's ultimately a synergistic relationship. In terms of the business model in your deck, I would also advise covering areas like, for example, your main channels for monetization, such as, for example, do you sell directly or do you sell through partnerships? If it's through partnerships, what kind of share do you give out to your partners, and what kind of share will be retained directly by you? As well as some other channels. For example, you might make some more money through advertising or licensing or other means as well. Once again, it's very important because it shows how exactly would you plan to make money and how quickly would investor potentially recoup his investment. So other than the business model, the things that I would advise you to focus on when either building out your deck or negotiating with your investors in a face-to-face conversation, I would advise you to talk about the market, right? The market is very important because yes, even if your product is very innovative and the market might seem big now, you would also want to show that it is also rapidly growing, or if it's not rapidly growing, then it's already big enough and that you would be able to have a defensible advantage when it comes to protecting your position against that of competitors. So on the slide about the market or during a conversation about the market, you would do well to not only talk about the current perspective, but also explain how exactly, for example, that market developed from 2020 to 2023, so to the present day, and what kind of market movers were the main ones that affected that growth. And also do a forecast from 2023 to 2026, for example, so a few years into the future, once again explaining, what would be the key market drivers. Because you would be focusing with your product on a specific geographical market at a stage where your company and your product are still young, you would do well, for example, to focus first of all on a single market, like let's say Pakistan, but also explain your global ambitions, right? So do a market analysis for Pakistan, but also do a market analysis for the global market so that your investors would understand how big, for example, is a Pakistani market in relation to the global picture. And they would also be potentially considering that you have global ambitions and how it can be achieved, because ultimately, whether or not it's a pitch deck or whether it's the conversation that you're having to face to face, every single point that you would be making would be explaining to the investor from different angles that you as a startup, you as a team would be a worthwhile investment, which is not as risky as your competitors outside of the boardroom, right? So you would be covering that from many different angles, from the angle of your team, from the angle of the market, from the product, from the competition, and many other areas. So once you've talked about the market, another key feature that is essential for you to address in your negotiations is a point related to your competitive standing, right? So there are many ways in which you can explain it. And personally, I've seen many ineffective ways. From my own perspective and experience, the most effective way to talk about your competition, for example, if you're doing it in a document, is to select 4 or 5 of your major competitors, some of whom might be, your startup competitors, other might be more corporate or traditional means of solving the customer's problem. And then analyzing the differences between you and them in great detail, not only in relation to the product and its features, but also in relation to other areas, like, for example, your geographical market, your exact customer niche, the amount of money that you charge to sell that product, as well as if you are comparing yourself to your startup competitors, you would also do well to include things like, for example, the amount of money that you fundraised, the date of your foundation, and other areas, so that the potential investors would be more able to have a perspective on, what kind of journey are you on in relation to the other main players in the market. Other than your competitive position, you should also obviously talk about your team. And ultimately, since the current conversation we're having is related mainly to the earlier stages, normally in those cases, especially in the developed market, it's very expensive and difficult to have a team which is very diverse and is comprised of many more people than just the original founders. So on the slide about the team, I would advise you to talk about each of the co-founders in detail, which includes, a picture of them, a brief background as to, what were their educational and professional experiences to date, what kind of things are they exactly responsible for in the startup, and how exactly do they know each other. Why is the last point important? Well, it's because ultimately, if you're doing an early stage startup, it is very, very likely that everything can go wrong, from fundraising to business development to approaching your customers to, competing against the existing entrants. So for the investor, it is very important to know that the founding team is able to work well with each other. They're able to adjust to the stressful situations that would eventually emerge. And it is much more likely that if the founding team knew each other for a while before, studied together or worked together, then they already know how to react to each other's quirks of the personality, so that yes, there may be trouble, yes, problems may occur in implementation, but it would not directly contribute to the breakdown of a startup, which you don't want, and the investors who gave you money don't want at all either. So in terms of the team, after you talked about the backgrounds of your co-founders, if you have any other people, like, for example, engineers or marketing people or programmers, feel free to include them as well. But on a more reduced basis, in that, for example, you've talked about your founders on the top, and then on the bottom of the slide, you would say that we are a total team size of maybe 20 people, and the rest are engineers and programmers, so that an investor can have an understanding of your potential burn rate, in that how much money you spend on salaries, as well as your existing capacity for scaling up into the future. Other than the team, another people-related aspect, which it is very important to consider when it comes to doing a pitch deck or negotiating with potential investors, is to talk about your advisory board, right? Because the advisors, normally they're the people who are very senior in their areas of expertise. So they might be CEOs of large corporations, they might be renowned business angels, they might be professors at universities who, for their seniority and experience, might not want to join your startup on a full-time basis, at least, at the current stage. But because you have a good rapport with them, or they really believe in the value and competitiveness of your idea, they might be able to advise to you on certain aspects of growing the business, whether it is the fundraising aspect, whether it is the aspect of approaching customers, or all the legal matters involved in setting up the office, doing the term sheets with investors, and the related aspects, right? And so on the second slide, after you've already talked about your core team, you should talk about your advisors, right? And also, because ultimately, they're quite well-known people, another benefit for you is that their names would also help you to sell your product and your startup into the eyes of your potential investor. So also include their photo, include the key areas of their expertise in direct relation to your startup, right? So for example, if you have a major university professor in AI and your startup is in AI, but that university professor also has a restaurant, right? Don't include that he has a restaurant, because it's not relevant. Spare the time of your investor. And also, when you talk about your specific advisors, also mention, how exactly are they helping you out? How exactly are they contributing to the growth of your startup? So that once again, the investor has a perspective on the degree that you guys are originally collaborating on, right? So that is another important point. Another aspect which is very important to cover would be talking about your financials. Unfortunately, since we're talking about the early stages like seed or Series A or pre-seed, often case it is very difficult for early stage startups to actually have enough financials to be forecastable and displayable on a deck or in conversation like that. So how can you talk about it then? So first of all, if you already have some kind of market validation, such as, for example, through pilots or through contracts, even if they're not very well paid or not paid at all, but if they are with big corporations who are well known in their field, by all means include that as well and mention what kind of degree of a business relationship do you guys have. So for example, if you were doing a contract, how long has it been going on for? What was the sums involved, and what it can potentially lead to if that business relationship continues on as planned, right? So in terms of money or in terms of scaling that product into additional verticals of the big corporation and stuff, so that once again the investor can have a perspective about your potential strategic growth. Other than that, also, if you don't have significant financials at the moment, but you're able to showcase any kind of metrics, such as, for example, once again, your burn rate, which means, the amount of money that you spend on paying the salaries of your team, or, for example, your unit economics, such as, for example, the customer acquisition cost, which means, how much money does it take you to get a customer and make him start paying for the delivery of your product or service, then by all means include those metrics as well, just to give your investor a better perspective. So other than that, also in a conversation, it is very important to mention your timeline, right? So the timeline basically means expanding from the situation you're on at the moment and going into the future for the next, let's say, 2 or 2.5 years, explaining the key milestones that you might have along the way. So first of all, why is it important not to go beyond the 2 or 2.5 years into the future? Because for you as an early stage startup, it is very, very likely that everything might change quite quickly, right? In terms of your growth, in terms of your competitive situation, in terms of the amount of contracts that you might have, and then investor understand it. So the longer that you forecast into the future, the less accurate the forecasts are likely to be. So in your timeline, I would advise you to focus on mentioning the things like, for example, your major milestones in terms of fundraising. So for example, you would talk about, so today is June 2023. In October 2023, we plan on fundraising our seed stage round, which would be to the sum of $2 million. And in a year's time, we focus on, our Series A, which would be on average of maybe 5 million. And you would also talk about your major milestones to do with product development. So for example, explaining which exactly would be the features that you're planning to introduce in a specific quarter or month, if you can, be accurate in terms of that. You would also talk about other aspects, like, for example, a major hiring milestones. Like, for example, at a certain date, you might be thinking of hiring another 20 programmers or 5 marketing people. And normally, in terms of, the product development milestones or hiring milestones, they would be going after the fundraising round that you have achieved, just because you would be having an influx of money, which you would be hopefully not hoarding, but putting to good use by expanding your team and your operational efforts. So other than those milestones, I would also advise you to mention things like, for example, entry into the different geographical markets, like, for example, expanding from Pakistan into China or from the US into the UK, as well as mentioning the delivery of your specific corporate contracts, because once again, if you're dealing with B2B, it is very likely that your sales cycles in terms of convincing your potential corporate customer to actually use your product would be very long. So for your investor, it is very important that he understands well as to, when exactly would you actually be signing that contract, or, when exactly would the money start arriving, because once again, it sort of starts to de-risk a little bit the investment that he would be potentially making. So other than the timeline, obviously, one of the most important slides of the pitch deck, and ultimately its main purpose, is a fundraising slide, right? So in terms of fundraising, I would advise you to focus on explaining how much money do you exactly want, what exactly would that money go towards, and do not say like, hey, we want to raise $1 million. Out of that, 200,000 would go towards our product growth, another 300 would go towards our salaries, and another 200 would go towards corporate development. Do not do that, because it is likely that your forecast would differ, and you would be spending more, or alternatively less, the amount of money that you have originally budgeted for a specific function. And it would give an investor an opportunity to potentially, dispute the operations that you would be planning to have. And it is not good to have conflicts with your investors in that stage. So just say, without mentioning the exact sums, the uses of that potential money. So for example, we want to raise 1 million. That money would go towards 1, expanding our team, 2, marketing, and 3, the delivery of our corporate contracts, or something like that. Also, do mention, the amount of money that you have fundraised before, if you have, right? Or if you, for example, invested a significant amount of your own money into that, also mention. And do mention, what kind of sources were there. So was there any renowned acceleration programs, business angels, VCs, and put in the logos as well, because it would ultimately show that, your solution and your startup has already been trusted by other renowned parties before. So once again, it's less risk for the current round investors. And on that slide, also talk about, what kind of things are you exactly looking out for from investors other than the money. So for example, it could be, access to a different geographical market that you are currently operating on, but you would want to expand on into the near future once you have a fundraiser round. It could be access to, R&D capabilities. It could be access to major corporates, which could potentially become your clients or partners, or many other related things. So do mention that, because ultimately, if you are a smart entrepreneur, you would not be wanting to take just any money. You would be wanting to take the smart money, right? So the money which can help you to grow beyond your current stage much faster than just a check would be potentially able to provide. And this is why, by explaining to your potential investors what you want, you would also be able to better differentiate between them and pick the ones that actually could contribute the most to the growth of your startup. Right, so that's about that. Now, just a few other points that I wanted to add. So first of all, once again, I come from an emerging market, as I understand the majority of you do as well. And myself, as an investor, I worked in many different markets before. I lived and worked and invested in Singapore. I worked in the UK. I worked in the US. I worked in the emerging markets. And I understand that, when it comes to the differences between the approach of entrepreneurs in the growing markets like Russia or Pakistan, in comparison to the West is, for example, their lack of understanding as to how to scale their product, right? So in Russia, for example, as well as I imagine it is in Pakistan, it is much more important for the entrepreneur to, at least in his own opinion, to have a product which is technologically perfect, right? So he would spend a lot of time and almost all of the available money in order to add new features, in order to make the product as aesthetically pleasing as possible, in order to defend his competitive position, whether it comes from, adding secret functional or buying up patents or other things. In comparison to that, in the UK or the US, the entrepreneurs focus much more on not the technological superiority, but on the commercial capacity of their product. Let me tell you my opinion as to what I think is best. I think that no matter where are you operating, whether it's Pakistan or whether it's UK, it's much more important to do it through the Western approach, right? So try and commercialize as early as possible, as long as you have managed to build up an MVP or a product which is ultimately in demand by the market. Why is that? Well, first of all, it is because no matter how much would you hope to make your product technologically perfect, the race to progress would never stop, right? Because you would have your competitors doing the things that you don't know about in many different markets. Some of the innovations you would not be able to even hear about, and others would be just simply too expensive for you because you are an early stage company. While if you focus on early stage commercialization, not only you would be able to validate your product from the viewpoint of the market, even if those market relationship that you have managed to build up so far, they are either unpaid or not very well paid, at least, it's a proof both to you that your idea is in demand, and to your potential investor that, if he gives you the money, then down the road, your product would ultimately be much more scalable. Also, what is a problem, of focusing too much on the patents and on ensuring your defensibility at a very early stage? Because unfortunately, the patents, especially, if you don't consider like Pakistani-wide patents, but ones in the US, or especially the ones which are scalable globally, first of all, they're very expensive in comparison to the amount of money that an early stage startup might provide. Secondly, they take a long time, which is, from my own perspective, much better spent when it comes to, actually, once again, ensuring your commercialization or building up new features of your product or fundraising or doing market research. So all the things which can actually, give you a more sustainable leg up rather than just, doing those patents. Second problem about the patents, other than their expensiveness and length of time required, is the fact that ultimately, they can be fairly easily circumvented, because you, as a early stage company, you have to understand that big corporations, they have a lot of people who are very smart, doing research on many both technological areas or scientific areas to do with a very small niche in which they're competent, right? So they do understand what kind of niche would the new innovations can potentially come from, and if that innovation is to come, what exactly would be the defining feature of that innovation. So if they understand that, a small startup, even if it's across the world, made a patent in that little niche, then it is likely that others would follow suit, and they can circumvent it by, making an umbrella patent, which would ultimately make your product not in demand, because they have the resources, they have the marketing power, they have the loyal customer base. You cannot compete with them at an early stage. What could be another solution other than just focusing on commercialization straight away? And this solution is much more applicable to the tech-heavy or hardware or deep tech companies, like, for example, the ones that we deal with, but at earlier stages. Well, a lot of deep tech companies or hardware companies in the developed markets like the US or the UK, they go into the so-called stealth mode, right? So stealth mode is a state of a company where the founders try and avoid revealing too much information about them to potential investors, to potential corporate partners, to potential media, which is related specifically to their product, to their vision, to their technological superiority, in order not to be spotted and outcompeted by their larger rivals, whether they're corporations or bigger startups, right? And it involves, once again, staying out of the media limelight. It involves not talking to everybody from the potential investors, but rather, talking to them much more carefully and making them sign NDAs. And it involves, focusing much more on early stage commercialization and building up your MVP rather than the public relations aspect, which is very important, but it is much more important at the growth stage, right? So once you already have a product, some money, and an understanding of how exactly would you be scaling up. And how do companies, enter in this so-called stealth mode? Well, first of all, some of them might be having a website which does not reveal any information about the vision, about the team, about the technological advantage. They might be, operating even under a different name. And you would not only see this kind of thing in startup world, you would also see the same when you look at companies like Google or Amazon or Facebook. Before they are sure that their product is well developed and there's a market for it, they would be making a fake name. Okay, I see that your hand is up. Let me just finish the sentence. They would be operating under a fake name, doing all the background research, and after that, only releasing onto the open market. So that's about the stealth mode. Now, Mohammed, happy to address your point.
Yeah, Alexander, so this is great. We have some questions. So considering that we have 17 minutes left, so I would appreciate that. Rafiq, if you could channel those questions one by one.
Yeah, sure. So well, let me go through the first, and I think one of the questions that is on mind of many of the startups, they are basically asking that they are not sure at this stage how to give up equity for the investment that other people are making into the startup. So is there any guideline on how much fundraising, on how much equity, and so on? So if you can give some ideas about how to do that at early startup phase.
Okay, got it. So look, ultimately, the amount of money that you would be able to fundraise and the equity depends on your own negotiating power, right? So if you're a serial entrepreneur with a product that is, very innovative, you've built up a good team, and you can communicate your vision very, very effectively, then it is likely that you would be able to twist the hands of some investors and arrive at better valuation. The actual valuation ultimately depends on the market. So for example, let's say if we take a seed stage company, the average valuation of a hardware company back in the US would be around 6 or 7 million, right? In Pakistan, it's much less than that. It's normally around 2 to 4. And once again, that differentiation depends on your product, depends on your vision and stuff. In terms of, the amount of equity that you will be planning to give away, on average, at least, in the US or the UK, at seed stage, you would be aiming to give away around 20% of equity, right? And usually it is more or less the same every round. So about 15 to 20% that, at seed stage and at Series A, and ultimately, as a result, the investor, the entrepreneur gets eventually diluted. Another thing, okay.
No, I just wanted to add that, especially this early stage, the best way is, because it's very difficult to quantify the valuation on your own, and let the proper VC venture capitalists, when they come in to invest for seed funding or round of funding, to decide how they would valuate your company. Until then, you can take these early stage investments more as a promissory note or safe note. And that is, so for example, if you take $250,000 as an investment or $100,000 as an investment, it's taken as you will issue a promissory note, and you will give some discount and possibly cap that when the company is evaluated properly at by the seed funding round, then the equity would be delivered to these early stage investor at a much preferred parameters, because obviously they took a higher risk and they invested much earlier, so they get an advantage of basically getting a share price lower at a discount as compared to the share price that a seed investor would make at that time. So if you could touch on that thing, Alexander, maybe that's.
Well, look, ultimately, it's very true that you said at early stages, just as you don't know your valuation, the investor knows it very sparingly. So the things that he would consider in terms of, whether or not to invest would be much more qualitative in the nature. So once again, he would look at your team, your market, your competitive vision and stuff like that. There do exist some metrics which, would help the investor to potentially arrive at a more financial valuation for your company. Like, for example, there is, the venture capital model, and there is another thing which is called the balance scorecard, and there is another thing called the Berkus method evaluation. And ultimately, what they do is they focus on things like, for example, assessing the risks that an investment into your company would have from a political standpoint, from an economic standpoint, from competitive, from technology, from the market, and assign an arbitrary monetary value to each of those points to reduce or to add to your eventual valuation. But once again, those are arbitrary. So the investors, even when they do use them, they use them as sort of a combination of many different methods, rather than just relying on your balance sheet and other financial metrics. Another way for you as an early stage entrepreneur to arrive at a more concrete valuation for your pre-seed or seed stage company is to go through an accelerator. Right? What are accelerators? Accelerators are programs which give you, an entrepreneur, a better understanding about how to do certain aspects of your business, like such as, for example, fundraising, business development, approaching customers, doing your pitch decks, hiring new additional employees. And because they deal with a lot of companies who are vastly different in terms of their stages, in terms of their geographies and sectors, they normally assign one valuation for all. Like, for example, a Y Combinator, which is a very well-known accelerator based originally in California in the US, I think they give around $150K for 7% of your company's equity, if that has not changed recently, and if I'm not mistaken. So ultimately, if they give you 150K for 7%, then you can obviously work out the valuation. What is just as a quick final point about the question, so what is the problem with accelerators when you try and approach them, is that normally the accelerators, they move at the pace of the earliest, of the slowest cohort member. So if you know how it's done, best not to approach them, and the money that they give is much, much smaller than the equity that they try and take away from you in return. So it can be helpful if you don't know how it's done. It can be helpful when you want to arrive at a valuation which you can later use to showcase to your other potential investors. But ultimately, there are better ways for scaling your business, even if it's an early stage company. Thank you.
So we will take an action item as well, that we'll have a session on this subject. This is a subject that matters to all of your startups, and we'll same guideline and share with you what various options are, and how it would be best fit for your needs. And as okay, with that, Rafiq, do you have another question?
Yeah, we have a couple of more questions. So
Please.
Alexander, this question is about, who is the right investor? Should you look for investors within Pakistan or outside Pakistan? Like, which one works better?
Well, look, ultimately, the right investor is the one who shares your vision and the one who can wait a long time if you're an early stage company, to not, try and pull out his investment, or to potentially even, give you more money as you're growing. When it comes to, selecting whether or not to focus on Pakistan or international straight away, it depends on your product, right? So if your core market is Pakistan, and you understand that in order to reach your core audience, in order to finish the development of your product, in order to do the right marketing, you need investors from Pakistan, then by all means get investors from Pakistan. But if your product is much more digital, if you understand that you know well how to reach customers in France or in the US or in China, then it is much more beneficial to get the investors who are local to the market, where the majority of your consumers come from. Now, when it comes to selecting those investors, ultimately, there are many different kinds of investors, right? There are big corporations, there are family offices, there are venture capital funds, there are business angels, there are acceleration programs, private equity firms, many others out there. At the earlier stage, right? So like, for example, if we are doing pre-seed to seed, normally the investors that you would be dealing with are either your own money, your friends and family. There is, the FFF round, which is, friends, family, and the so-called fools, right? Because there is so little validation, it's so risky that few people still believe. And then once you raised a little bit of money from your own sources, then you would go into a slightly more open of a market. You would approach business angels. For business angels, normally, the checks that they give are relatively small, and the smart money that they would provide would be quite limited as well, and it would be limited to potentially only the connections that they can offer to you in terms of other investors, or reaching out to big corporations, maybe with whom they have a long working or collaboration history, or maybe once again the early acceleration or incubation programs. Now, if you focus on the international markets, for example, there are more options out there. Like, for example, you can approach the so-called venture studios, right? The venture studios are vehicles which give you money at a very early stage, and then they step in to act as your co-founders by focusing on your needs away from the areas in which you're currently strong. So let's say, for example, you're a very, very strong technical entrepreneur with a good understanding of how to scale your idea. Well, venture studios can step in when it comes to helping you with R&D or with marketing or with, reaching out to specific clients. And then eventually, they would be even willing to give you more and more money at each stage of your growth. And they would not even be wanting to put you into the open VC market, because they have the resources, and because they are originally acting as co-founders, they would be having quite a significant bigger chunk of equity than an individual business angel or venture capital investor would be willing to get. Finally, you know, other than the venture capital studios, business angels, and acceleration programs, you could also, especially in the West, aim to approach other parties, like, for example, venture debt or grants from governments, from charitable foundations, from corporations. Normally, the grants are a good idea for two reasons. First of all, it's an equity-free chunk of money. And two, it provides validation that, you know, your idea is innovative and it is in demand by the market. What is the problem with the grant? It is normally, you know, a very small amount of money, so it's not going to last you for a long time. So if you're getting a grant, great, but, you know, don't spend too much time on securing it, and project other sources of potential financing to support it as well.
Great. Last question, Afiq.
Okay.
Yeah. So one question is about, you know, there is, let's say you have a startup who is working primarily as a services company, providing services to other startups or other businesses. Now they are moving into their own product company. So the question is, are investors usually interested in that kind of startups which are transitioning from services to product-based companies, or is there a hurdle that people need to be aware of?
Well, look, so once again, you know, there are many, many different investors out there. If you manage to interest them in your vision and your business model, then for sure they are. Normally, it's a problem. Why is it a problem? Because when you're in the transition period, it means that your original idea, at least, you know, in the majority of cases, it was not as successful as you have originally envisaged, right? So maybe you did not find the right product to market fit. Maybe you found that, you know, the price that you are charging is unsustainable. Maybe you just found a better business niche and you want to allocate all of your resources to that niche. So ultimately, it shows that your original ideas were wrong. And the attitude of investor really depends, right? So for example, in the US, there is just so much more money out there that it is much more dangerous for the investors not to invest in the company that at a later stage becomes very, very successful than to invest in a company and have this company go bust, right? Because then they would be ridiculed and then everybody would be talking about the next big thing which they missed. They don't want that to happen, right? So they're much more risk-taking, even if it means that, you know, the startup that they have invested in would potentially undergo pivots, right? What is a pivot? It is exactly the thing that you've mentioned. So, right, a change in the business model or a significant difference between the original and the next product, or, you know, a rapid shift towards a different geographical market. When we talk about Pakistan, Russia, or many other developing markets, ultimately the situation is very different in that, first of all, there is less money, and so a small amount of potential investors. Secondly, the investors are more risk averse, and thirdly, they are much more interested in, you know, putting their hand into your operations, even if it means, you know, a direct conflict between them as an investor and you as an entrepreneur. So this is why it is important to have an investor that shares your vision, even if, you know, as I've mentioned to you before, everything, especially at the earlier stages, things might not go smoothly, right? And as a final point about that, ultimately, you know, even in the developed markets, even if, you know, if the company successfully navigated the pivot, it is likely that for some reason or another, they did not reach the exact milestones that they have originally planned, right? So the milestones in terms of, you know, revenues or geographical presence or product development or many others. And this is why, you know, the company is about to run out of money before reaching those milestones. And they would have to fundraise a so-called bridge round, right? A bridge round is basically the amount of money that is necessary for the startup company in order to reach those milestones and not go bust. And for the investors, ultimately, it is a choice between, giving a little bit more money into a company and potentially, making it successful, or not leaving it, not giving more money, and having this company go bust and fully, losing their stake. Ultimately, they more likely opt for the first option, especially, if they can afford it. Hopefully that answers the question.
Great. I think we are at the end of the time, but Alexander, you have done a great job. Really appreciate that thing, and hopefully, people and on the call they were able to get the ideas and related to and be able to relate to their respective startups. So again, Alexander, thanks for your time. Appreciate that thing, and making yourself available. I didn't realize that you were on the road in Dubai, but really appreciate your time. And all of the folks, and as you may have some questions, and please post those things in WhatsApp group, and we'll figure it out the pattern of those questions, and we'll follow up in a group form subsequently. With that, thanks, Rafiq, again for your help, and thank you very much for joining. All of you guys. Bye-bye. Allah Hafiz.
Thank you. Thank you. Bye.
Yeah, just as a final point, I've added my LinkedIn onto the chat here. If anybody wants to connect or ask any further questions, happy to elaborate at a different time. Thank you.
Thank you.